the Federal Reserve. Just saying the name brings to mind these whispers in financial circles, analysts glued to their screens, trying to decode the next move from the world's most powerful central bank.
It really does. It feels like they're peering into a crystal ball sometimes, doesn't it?
Right.
Making these huge decisions that just ripple across the entire global economy.
Exactly. And among all the signals they send out, the ones designed to give us a glimpse of their thinking, there's one that really stands out.
Oh, yeah.
It gets intensely scrutinized,
Yeah.
often debated, and sometimes, well, let's just say it leaves people scratching their heads a bit.
It truly is one of the most anticipated moments after certain Fed meetings. You see market participants dissecting it dot by dot, really hoping to find a clear map of where interest rates are headed.
But as we're probably going to find out, that map can sometimes be a little misleading.
That's putting it mildly sometimes, yeah.
And that signal, that much-discussed chart, is the Fed's dot plot. So welcome, everyone, to the Deep Dive.
Hi there.
We've really plunged into a stack of sources for you today. Everything from the real nitty-gritty of the latest FOMC meeting minutes from March 2025 to expert analysis from places like Investopedia, Bankrate, City Journal, Mergence, Charles Schwab, even Apollo Global.
Quite a range.
Our mission today is to truly unpack this thing.
We're going to get into what the dot plot actually is, why the Fed even decided to start publishing it way back when.
Right.
Then look at what key takeaways emerged from the most recent one, the one that came out after the March 2025 meeting.
And maybe most importantly.
Yes, and perhaps most crucially, how accurate has it actually been over the years? Does it really work?
The goal here is to give you a clear picture of this influential, yet, like we said, frequently misunderstood tool, so you can better understand what it might tell us, or maybe what it fails to tell us, about the potential future path of U.S. interest rates.
Okay, sounds like a plan. Where should we start?
Let's jump right in by starting with the entity that actually produces this chart, the Federal Open Market Committee, or the FOMC.
Right, the FOMC. This is really the critical engine room within the whole Federal Reserve System. The Fed does a lot of things, but the FOMC is the specific group responsible for setting U.S. monetary policy.
So they're the ones deciding how much money is flowing, and crucially for our chat today, guiding the direction of interest rates.
Exactly. They're pulling the levers.
And its structure is quite specific, isn't it? Not just anyone sits on this committee.
No, it's very defined. The FOMC is composed of 12 voting members. 7 of those are the members of the Federal Reserve Board of Governors. These are folks appointed by the president, confirmed by the Senate, serving long terms.
Okay, the governors.
Right. The other 5 voting members are presidents of the 12 regional Federal Reserve banks. Now, the president of the Federal Reserve Bank of New York, that's a special case. They always hold a permanent voting seat.
Because New York is such a financial hub.
Precisely. Its central role in global finance makes that position critical. The remaining 4 voting seats rotate annually among the presidents of the other 11 reserve banks. There's a set schedule to make sure different regions of the country get a voice over time.
And we know, based on our sources like Investopedia and the recent minutes, that as of early 2025, Jerome Powell is still the chair of the FOMC.
Correct.
And John Williams, who is the New York Fed president, is the vice chair.
Right.
The other governors currently include names like Michael Barr, Michelle Bowman, Lisa Cook, Philip Jefferson, Adriana Kugler, and Christopher Waller.
That sounds right.
But here's a key point for the dot plot later. Well, only 12 people get a vote on the actual policy decision.
Yes. This is important.
All 7 governors and all 12 Reserve Bank presidents actually attend the meetings. They all participate in the discussions.
That's right. So you have a much larger group involved in the deliberations than just the 12 voters, and that becomes very relevant when we talk about who contributes to dot.
Okay, so what's their main tool? How does this committee actually influence rates?
Well, their primary tool, the main lever the FOMC pulls, is directing what are called open market operations.
Buying and selling government bonds.
Essentially, yes. It involves the buying and selling of U.S. government securities, like Treasury bonds, in the open market. The whole purpose of these operations is to influence the supply of reserves, basically, cash that banks hold within the banking system.
And that influences the federal funds rate.
Exactly. That directly affects the federal funds rate.
And the federal funds rate, just so we're all clear, that's the target rate for overnight lending between banks, right? It's
Yeah.
like the base rate for everything else.
Precisely. Think of it as the foundational rate in the U.S. financial system. When the Fed changes its target for this rate, it ripples outwards almost immediately.
How so?
Well, by influencing this rate, the Fed directly impacts other short-term interest rates across the economy. And then through a more complex transmission mechanism, it also indirectly influences longer-term rates.
Things that affect us more directly, like mortgages.
Absolutely. Things like the interest rates on mortgages, car loans, credit cards. It also affects the overall availability of credit, which influences businesses' decisions about whether to invest and expand.
Which then impacts hiring, jobs.
Employment levels, and ultimately overall economic output. Yeah, it's really fundamental to the economic plumbing, you could say.
And they're not just doing this on a whim. They have specific goals given to them by Congress, right? The dual mandate.
That's their legislative charge, exactly. The dual mandate requires the Fed to promote 1, maximum employment, and 2, stable prices.
And stable prices they've defined pretty clearly.
Yes, they have. They've defined their stable prices objective quite explicitly. They've reaffirmed their commitment to targeting a 2% inflation rate over the longer run. This was stated again in their most recent statement on longer-run goals and monetary policy strategy.
So this powerful committee, the FOMC, they meet 8 times a year, roughly every 6 weeks or so.
That's the schedule, yes.
Yeah.
8 times a year.
And these meetings, they aren't public spectacles. They happen behind closed doors. So everyone, market participants, the public, eagerly awaits the statements and documents released afterward.
Mm-hmm. The announcement is always a big moment.
And one of those intensely dissected documents that comes out of some of those meetings is the Summary of Economic Projections. The SEP-P, that only comes out 4 times a year, quarterly.
Correct. March, June, September, December. And this SP document, well, this is where the famous or perhaps infamous dot plot resides.
Okay, let's zero in on the dot plot itself then. What exactly is this chart that causes such a stir every quarter?
Okay, think of it as a visual snapshot, but it's a snapshot of individual policymakers' predictions, their forecasts. It's a chart included within that quarterly cell.
Right.
For each SEP release, every single FOMC participant, now remember, that includes all 7 governors and all 12 Reserve Bank presidents, so potentially up to 19 people if the board is fully staffed.
So not just the voters,
Yeah.
everyone in the room, basically.
Everyone in the room who's part of that core group, yes. They each submit their individual anonymous projection, and they project what they believe will be the most appropriate midpoint for the target range of the federal funds rate.
For when?
At the end of the current calendar year, at the end of each of the next few years, usually 2 or 3, depending on the time of year, and then, importantly, their estimate for the longer run.
Ah, the longer run dot. That's often talked about as their estimate of the neutral rate.
Exactly. That longer run projection is generally interpreted as each individual's estimate of the neutral rate of interest, that sort of theoretical rate that would keep the economy growing steadily, with stable prices and full employment, neither hitting the gas nor the brakes.
So if I look at the chart, what do I see?
You'll see a chart. The y-axis, the vertical one, shows the federal funds rate level. The x-axis, the horizontal one, shows time columns for the current year-end, next year, the year after, and then that longer run column. And within each of those columns, for each time period, you see a collection of dots scattered vertically. Each single dot represents one person's forecast for the appropriate policy rate at that specific point in time.
So if the Fed is fully staffed, there could be up to 19 dots in each year's column.
Potentially, yes. Though vacancies can mean fewer dots sometimes.
How do people, analysts and reporters typically make sense of this scatter of dots?
Well, while every single dot represents a distinct viewpoint, the market and the media tend to focus very heavily on the median dot for each year.
The middle one.
The middle one, yeah. If you lined up all the dots from lowest to highest, the median is the one right in the middle. It's often seen as representing the committee's collective center of gravity, their kind of baseline expectation for where rates are likely headed.
But you shouldn't just look at the median, right? The spread matters too.
Oh, absolutely. The spread or dispersion of the dots is incredibly important. If you see the dots clustered tightly together in a given year, that suggests a high level of consensus among the policymakers.
Everyone's kind of on the same page.
Right. But if you see the dots spread out widely across a large range of potential rates, that indicates significant disagreement or maybe just a lot of uncertainty among them about the right path forward for policy.
And this whole picture gets updated 4 times a year, you said.
Yeah.
March, June, September, December.
Correct, after those specific FOMC meetings. And there's a slight difference. The March and June S&Ps typically project out for the current year, the next 2 years, and the longer run.
Okay.
Then the September and December releases usually extend that forecast horizon by adding a third full year into the mix before the longer run column.
Got it. So we have this mechanism, these anonymous dots showing individual forecasts. Why? Why did the Fed even start doing this back in 2012? It feels like a big step towards being more open.
It really was. The dot plot was formally introduced in January 2012, and as our sources like Bankrate and City Journal discuss, the main motivation was rooted in this concept of aggressive forward guidance.
Forward guidance meaning telling people what you plan to do in the future.
Exactly, giving markets a heads up. But the aggressive part comes from the specific economic context back then.
What was happening in 2012?
Well, remember, the U.S. economy was still really struggling to recover from the deep scars of the 2008-2009 Great Recession. Interest rates, the main policy tool, had been slashed to effectively zero back in late 2008 and had just stayed there for years.
Right, the zero lower bound.
Exactly. And the Fed was also doing unconventional things like quantitative easing QE, buying up trillions of dollars in treasury bonds and mortgage-backed securities to try and push longer-term rates down even further.
So they couldn't cut rates anymore. They needed other ways to signal their intentions or stimulate the economy.
Precisely. With the main policy rate basically maxed out at zero, the Fed needed other tools. Forward guidance became really important. They needed ways to provide ongoing support and, crucially, manage market expectations about when and maybe how quickly they might eventually start raising rates again once the economy recovered.
They wanted to avoid surprising the markets later on.
That was a big part of it. Prepare markets for the eventual exit from those emergency settings, the near-zero rates, the QE. Avoid a taper tantrum situation like we saw hints of later.
And the thinking was more transparency about their future plans would help achieve this smooth exit.
Yes. The theoretical benefit, as highlighted in the sources, was that by making their internal thinking and future policy intentions more explicit via the dot plot, they could reduce uncertainty for businesses, for households.
Make people more confident to borrow or invest.
Potentially, yes. And also, crucially, avoid causing unnecessary market volatility down the road when they did eventually decide to lift off from zero. The idea was clearer signaling makes policy transmission more effective, less drama.
City Journal brings up some interesting economic research on this point, suggesting that what the market thinks will happen with rates is incredibly powerful in itself.
They do, and that research is quite compelling. It suggests that the market's collective belief, its expectation about where rates are heading in the future, might be as powerful, or maybe even more powerful in some circumstances, than the Fed's actual setting of the short-term rate today.
How does that work?
Well, think about it. If markets become convinced that the Fed is going to raise rates significantly over the next year, that expectation alone can cause borrowing costs for longer-term things like mortgages, corporate bonds to increase now, even before the Fed officially moves its target rate.
So the market front-runs the Fed based on expectations.
Exactly. And the dot plot was designed in part to try and harness this power to actively shape those market expectations in a direction the Fed felt was appropriate.
So it wasn't just a passive forecast like, here's where we think the economy will push rates. It was more active, maybe even a commitment.
That's precisely how City Journal frames it. It was conceived, they argue, as both a prediction of where the economy was heading and what policy would be appropriate, and as a sort of promise or signal about how the Fed intended to react to that future economic state.
Wow. So transparency, signaling future actions, guiding expectations, reducing volatility, those are some pretty ambitious goals behind introducing this chart back in 2012.
Definitely ambitious, born out of a very challenging economic period.
Okay, that sets the stage really well. Let's fast forward now to the present, or at least the most recent data we have in our sources. Let's talk about the dot plot that came out after the FOMC meeting on March 18th and 19th, 2025. What did the minutes from that meeting and the analysis afterward tell us?
Okay, so the first thing is the actual policy decision at that meeting. It was pretty much in line with what markets were expecting. They decided to maintain the target range for the federal funds rate at 4.25% to 4.5%.
So rates held steady, no change in March.
No change. They judged that the economic conditions at that moment didn't warrant either a cut or a hike.
And how did the committee members describe those economic conditions in the minutes? What was the backdrop for that whole decision?
Well, participants generally characterized the pace of economic activity as solid, That's Fed speak for doing okay, not booming, not shrinking.
Right.
The labor market was seen as being broadly balanced. The unemployment rate had stabilized at a low level, which suggested to them that the job market wasn't significantly overheating, but also wasn't deteriorating rapidly either. Kind of a Goldilocks view, maybe?
But there's a but, wasn't there? Inflation.
Why, yes, the big but. They explicitly noted that inflation, while down from its peaks, remained somewhat elevated relative to their official 2% target. And somewhat elevated in central bank language usually means still too high for comfort.
Okay. And the minutes specifically called out increased uncertainty about the outlook, didn't they? That seemed like a key theme.
Absolutely. Uncertainty was mentioned repeatedly. Participants explicitly stated that they saw the risks to the economic outlook as being tilted.
Tilted. What does that mean exactly?
It means they didn't see the risks as evenly balanced. They perceived a higher probability of certain outcomes compared to others. Specifically, risks were seen as tilted to the downside for employment and growth.
Meaning a greater chance things could slow down more than expected.
Exactly. A greater chance the job market and overall economic activity could end up being weaker than their baseline projections. But conversely, the risks were seen as tilted to the upside for inflation.
Meaning a greater chance inflation stays higher for longer or even goes back up.
Precisely. A greater concern that inflation could persist at higher levels or maybe even accelerate again compared to their central forecast. So worried about growth slowing, but also worried about inflation sticking around. A tricky spot.
And what was driving that increased uncertainty and those tilted risks? Did they point to specific factors?
Yes, a significant factor that was explicitly highlighted in the minutes and also kicked up in analysis like Charles Schwab's was the highly uncertain path of tariff policy, trade policy uncertainty.
Tariffs again.
Yeah. Several participants voiced concerns that potential changes or, escalations in trade tariffs could directly boost costs for businesses, which would then likely get passed on to consumers. Higher inflation risk.
Makes sense.
But beyond just the direct cost impact, the sheer uncertainty surrounding what future trade policies might actually look like was seen as a potential drag on the economy.
How so?
Well, if businesses are uncertain about future tariffs, future costs, future market access, they might just hold off on spending, delay investment plans, maybe be more cautious about hiring. That uncertainty itself could dampen economic activity, contributing to those downside risks for growth.
So tariff policy concerns were hitting both sides of their worries, potentially boosting inflation and potentially hurting growth.
Exactly. It wasn't just a minor side issue. It was clearly influencing their assessment of the overall economic risks and uncertainties at that March meeting.
What about the more detailed discussion on inflation itself within those minutes? You said it was somewhat elevated.
They acknowledged the progress inflation had eased considerably over the previous 2 years from its very high peaks. But they reiterated, still too high relative to 2%. And a key point of discussion, maybe a worrying one for them, was that recent data specifically for January and February of 2025 had actually come in higher than they expected.
Not what they wanted to see.
Definitely not. That naturally heightened concerns about whether the downward trend in inflation was stalling out. They noted some components were improving, like housing services inflation, which had been a major driver but was finally starting to moderate.
That's good news, at least.
Yes, but offsetting that, they pointed to inflation in core non-housing services, especially what they call non-market services, remaining stubbornly high.
Could you remind us what non-market services typically includes?
Sure. It generally refers to things like healthcare services, education, certain financial services, insurance. These are sectors where prices aren't always set in the same highly competitive, quickly adjusting way that, say, prices for electronics or clothes might be.
So their prices can be stickier.
They can be stickier, yeah.
Yeah.
And costs in those sectors were proving persistent. The minutes also noted that core goods inflation, which had actually been negative for a while, had picked up again recently.
Why was that?
Well, many participants suggested this might be linked back to those tariff concerns, businesses perhaps anticipating higher import costs down the line and starting to reflect that in their pricing already.
It really does all seem interconnected. Tariff worries feeding into both growth risks and these specific inflation components.
It paints a picture of a complex, uncertain environment. On a slightly more positive note for inflation, though, participants did note that measures of longer-term inflation expectations remained well anchored.
And why is that so important to the Fed?
It's crucial. If people and businesses generally believe inflation will return to 2% over the long run, it helps prevent inflationary psychology from taking hold. It stops things like a damaging wage price spiral, where workers demand much higher wages because they expect high inflation, prompting businesses to raise prices further, creating a self-fulfilling prophecy. Anchored long-term expectations are a key asset for the Fed.
But you said longer term. What about the near term?
Well, that was less positive. Almost all participants pointed out that measures of near-term inflation expectations, what people expect over the next year or so, had actually risen recently.
Likely because of those higher than expected inflation readings in January and February.
Very likely, yes. People react to the data they're seeing now. So long-term expectations okay, near-term expectations ticking up, actual recent data a bit hot. You can see why they felt uncertain.
Okay, that paints a really detailed picture of the economic assessment at that March meeting. Now, the big question. What did the dot plot itself, the actual projections of future rates, show based on all this?
Right. So according to bank rates analysis of that March 2025 CEPI and the associated dot plot, the median projection among all the participants continued to signal an expectation of 2 rate cuts for the calendar year 2025.
2 quarter-point cuts sometime before the end of 2025. That was the middle ground view.
That was the median, yes.
But given all that uncertainty and the tilted risks they just talked about, what much agreement was there around that median? You mentioned the spread of the dots is important.
And it was very telling in this case. Bank rates' breakdown of the individual dots shows a significant divergence of opinion, really highlighting that uncertainty.
So what does it look like?
While the median showed 2 cuts, and indeed 9 policymakers had exactly 2 cuts penciled in for 2025.
Okay, a solid group for 2 cuts.
Yes, but then you had 2 officials who were more aggressive, projecting 3 cuts for the year. But importantly, on the other side, you had a notable group of 4 participants who expected only a single rate cut in 2025.
Only 1 cut.
And even more cautious, another significant group of 4 participants expected no change at all to the federal funds rate throughout the entire year 2025. Hold steady all year.
Wow. So let me get this straight. 9 expect 2 cuts. But then you have 4 expecting just 1 cut and 4 expecting 0 cuts. That's 8 people seeing either 0 or 1 cut. Versus 11 seeing 2 or 3. That's quite a split, almost half the committee leaning more cautious than the median.
It really is. It vividly illustrates the internal debate and the different ways policymakers were weighing those competing risks. The risk of inflation staying too high versus the risk of growth slowing too much. There wasn't a strong consensus view on the right path forward for the rest of the year.
In bank rate mention, this was actually less aggressive than the previous dot plot from December.
That's right. The interpretation was that compared to the December 2024 projections, this March 2025 set of dots, while still showing cuts, was leaning slightly less towards easing policy, perhaps reflecting those sticky inflation readings early in the year.
Were there any other notable forecasts within that March SP that the minutes discussed? Anything on inflation or growth projections themselves?
Yes, they did note that the Fed staff's projections for inflation had been revised up slightly for 2025. Again, primarily reflecting those higher than expected readings in January and February.
So the staff forecast acknowledged the recent stickiness.
It did. For instance, the median projection for year-end PCE inflation in 2025 was nudged up a bit, maybe to around 2.7% or 2.8% for core PCE, if memory serves from the bank rate summary. The staff still projected inflation eventually getting back down to 2%, but not until maybe 2027.
Still a ways off.
Still a ways off. And interestingly, the staff explicitly noted that their forecast included what they called placeholder assumptions for future trade policy. And these assumptions were adding upward pressure specifically to the inflation forecast for 2025.
Placeholder assumptions. What does that imply? Does that mean they were just guessing about tariffs?
It suggests exactly that they had to make some kind of educated guess or assumption about what future tariff policies might look like, because the actual policy path was unclear. They acknowledged this uncertainty and that different outcomes could significantly alter their inflation forecast. They basically had to plug something in, but flagged it as a key uncertainty.
That makes sense. The minutes also mentioned a decision about the Fed's balance sheet, didn't they? Not the dot plot directly, but related to their overall policy stance.
Yes, that was another significant outcome from the March meeting. Almost all participants supported a decision to slow down the pace at which the Fed was shrinking its large holdings of Treasury securities and agency mortgage-backed securities. This shrinking process is often called quantitative tightening, or QT, or balance sheet runoff.
Slowing down QT, how much slower?
Specifically, they agreed to reduce the monthly cap on how many maturing Treasury securities they would let roll off their balance sheet without reinvesting the proceeds. They cut that cap significantly, from $25 billion per month down to just $5 billion per month, starting in April 2025.
Wow, that's a big reduction in the pace for treasuries. What about the mortgage-backed securities?
They decided to keep the cap for agency debt and mortgage-backed securities, MBS, unchanged at $35 billion per month. So the slowdown was focused entirely on the Treasury side.
And what was the reasoning behind slowing down the runoff, especially for treasuries?
The stated rationale, according to the minutes, was primarily technical. It was about managing the level of reserves in the banking system that cash banks hold at the Fed. They wanted to guard against the risk of reserves becoming accidentally scarce.
Reserve scarcity, meaning banks might run too low on cash held at the Fed.
Potentially, yes. As the Fed shrinks its balance sheet by letting assets run off, reserves drain out of the banking system. If reserves fall too low, too quickly, it could cause unwanted volatility in short-term money markets like the repo market and disrupt the smooth functioning of the financial system's plumbing. They saw slowing the runoff as a way to approach the right long-run level of reserves more carefully and reduce the risk of hitting scarcity abruptly.
So they framed it as a technical adjustment, not a change in their interest rate policy stance.
Exactly. They went out of their way to emphasize that. The minutes state the change was intended to ensure smooth market functioning and had no implications for the policy stance. They didn't want markets to interpret slowing QT as a signal that rate cuts were suddenly more imminent or that their overall view on tightening had changed. It was presented as purely operational.
But even on that technical adjustment, there wasn't unanimous agreement. I think you mentioned a dissent.
That's right. Governor Waller actually voted against this decision to slow the runoff.
What was his reasoning?
His reasoning, detailed in the minutes, was basically that he didn't see the need for it yet. He argued that reserve balances were still very high, exceeding $3 trillion at the time, and he saw no current signs of impending scarcity based on money market indicators or his conversations with banks. He felt the Fed had other tools already available, like the standing repo facility, to handle any temporary strains in money markets if they actually emerged. So, in his view, preemptively slowing the runoff now was unnecessary.
Interesting. It shows there's debate and differing views even on the more operational aspects, not just the headline interest rate path.
Absolutely. Even the technical decisions involve judgment calls.
Okay, so let's try to summarize the key takeaways from that March 2025 picture then. We had rates held steady at 4.25% to 4.5%. The economy described as solid, but facing significant uncertainty. Risks tilted towards weaker growth, but also, worryingly, towards higher inflation. A lot of that uncertainty was linked to tariff policy concerns and some recent hotter-than-expected inflation data.
Right.
The dot plot's median forecast signaled 2 rate cuts for 2025. But underneath that median, there was a really wide range of individual opinions. A significant number of participants expected only 1 cut or even 0 cuts for the year, reflecting all that internal uncertainty and debate.
A very split committee, you could say.
And finally, they decided to significantly slow the pace of their balance sheet reduction. QT, focusing the slowdown on treasuries, framing it as a technical move to avoid reserve scarcity, although even that decision faced some internal dissent.
That captures the essence of the March 2025 meeting and Sepia pretty well, based on our sources. A picture of cautious holding, significant uncertainty, and internal disagreement on the path forward.
Now, this brings us to the really critical part of the discussion. All this information, especially the dot plot itself, is presented as a signal, right? A guide to future policy.
Yeah.
But let's get brutally honest here. How accurate has this tool actually been in the past? Has it lived up to that original promise of being a reliable, forward-looking indicator?
Yeah, this is where the critiques, particularly from sources like City Journal and Mergence, become quite pointed. And frankly, the historical record raises some serious questions.
What's the fundamental issue?
Well, the fundamental issue, as they see it, boils down to something pretty basic. The economy is just inherently unpredictable. Forecasting is hard. The dot plot essentially asks these 19 individuals to predict the incredibly complex path of the U.S. economy and the appropriate interest rate response years into the future. And the reality is, no one, not even the very smart economists at the Fed with all their models and data, can do that with consistent accuracy.
So the dot plot just makes the Fed's forecasting limitations very public.
In a way, yes. City Journal argues it lays bare the fact that the Fed doesn't possess a superior crystal ball compared to anyone else trying to guess the future.
And City Journal also argues that this lack of perfect foresight, when combined with a tool that's designed to signal future actions or intentions, can actually backfire. it can potentially undermine the Fed's credibility.
That's a central part of their critique. The argument goes like this. If the Fed publishes these projections, which markets naturally interpret as guidance, and then those projections repeatedly turn out to be significantly wrong, well, that can damage the market's trust.
Trust in the Fed's analysis. Trust in their ability to manage the economy.
Both, potentially. If the forecasts keep missing the mark, people might start wondering if the Fed really understands what's going on or if they're capable of sticking to a plan. And this loss of credibility, City Journal argues, is particularly damaging when the Fed is trying to do something difficult, like fighting high inflation after a long period of promising low rates. In those situations, market belief in the Fed's resolve and competence is absolutely paramount. Repeated forecast errors can weaken that belief.
Okay, let's make this concrete. Can you walk us through some of the specific historical examples cited in our sources where the dot plot projections really missed the mark?
Sure. A very prominent and relatively recent example that both City Journal and Bankrate highlight comes from the dot plot released in December 2021.
What was the context then?
Well, inflation was clearly accelerating rapidly by late 2021. It was becoming obvious that the transitory narrative wasn't holding up. The Fed was just starting to pivot away from its pandemic-era stimulus towards a tighter monetary policy stance.
So what did that December 2021 dot plot predict for the path of interest rates in the coming year, 2022?
The median projection in that December 2021 dot plot signaled that the federal funds rate target range would likely only need to rise to somewhere around, maybe slightly above, 2% by the end of 2022. Some individual dots were even lower than that.
So predicting a fairly gradual increase to around 2% by the end of the next year.
Yes, a relatively modest tightening cycle was implied.
And what was the reality? Where did the federal funds rate actually end up by December 2022?
The reality was dramatically different. Faced with persistent multi-decade high inflation through 2022, the Fed was forced to embark on one of the most aggressive and rapid rate hiking cycles in modern history. By the end of December 2022, the target range wasn't near 2%. It was a whopping 4.25 to 4.5%.
Wow, that's not just a slight miss, that's orders of magnitude off.
It was a colossal misjudgment of the degree of policy tightening that would be required. As City Journal puts it, the implied promise of the dots wasn't kept, and the prediction was spectacularly wrong. It really highlighted how quickly the economic reality and the necessary policy response could diverge from the forecast.
And City Journal also pointed to an associated inflation forecast from around that same time that also missed badly.
Yes, they note that Fed projections around late 2021, early 2022 often implied that inflation would be well on its way back down to the Fed's 2% target, or at least very close to it, by the time of the article's writing in early 2024.
And that didn't happen either.
No, inflation remains stubbornly above 3% well into 2024, demonstrating another significant forecasting failure from that period.
Now, Mergent's investment managers, in their analysis looking at the dot plot's longer history, they provide other examples too, right? It wasn't just the 2021-2022 period.
That's correct. Their historical chart analysis suggests a pattern of misses, though perhaps less dramatic ones sometimes. For instance, they argue the Fed's dot plot projections were generally too early in forecasting the start of the previous tightening cycle back in the 2015-2018 period.
Meaning the dots showed rate hikes coming sooner than they actually materialized.
Exactly. Policymakers kept penciling in hikes, but the economic data often didn't quite cooperate, leading to delays. Then, looking at the sharp cutting cycle in 2020,
Triggered by the pandemic.
right, they note the dot plot obviously didn't anticipate that rapid cutting cycle down to zero. Now, you have to give them a pass on that one. Perhaps predicting a global pandemic is beyond any economic model.
Fair enough.
But even during the very sharp hiking cycle of 2022-2023, where rates eventually went from near zero all the way up above 5%, Mergents points out that while the dots did eventually move upwards to reflect reality, they consistently seem to underestimate the speed of the hikes.
So the dots were always playing catch-up to the actual pace of tightening.
It appears so, yes. The median dot would get revised higher meeting after meeting, but often lagged behind where rates actually ended up going in the subsequent months.
And what about forecasting the current cycle, the potential for cuts that we saw in the March 2025 plot?
Well, Mergents' analysis, written back in June 2024, suggested the Fed appear early in forecasting the current cutting cycle. At that time, June 24, the median projection was for one 25 basis point cut later in 2024.
Which hadn't happened by then.
Right, suggesting the timing was already looking potentially off. And their forecast path for subsequent years reaching 3.1% by end 2026, averaging 2.8% thereafter, might also prove premature if inflation remains sticky or other shocks emerge.
Bankrate also had another example looking back at the pandemic itself, right? December 2020?
Yes, they reminded us of the dot plot from December 2020. This was deep in the pandemic recession, massive uncertainty. The projection back then showed that most officials expected interest rates to remain pinned near zero all the way through the end of 2023.
3 full years of zero rates predicted.
That was the median view in late 2020. Of course, as we know, the subsequent surge in inflation starting in 2021 completely invalidated that path, forcing the rapid hikes of 2022 instead. Another major miss.
So these consistent discrepancies, these misses, whether in timing, speed, or overall level, this is what critics, like Apollo Global's chief economist, cited in one source, point to as potentially lessening the Fed's credibility.
Exactly. And City Journal's core argument is that this potential damage to credibility is a serious problem, especially, as we said, when the Fed needs the public and markets to believe in its commitment, like when fighting inflation. They see it as exposing an inherent weakness in the Fed's post-Great Recession approach, which tried to blend the supposed benefits of rules-based predictability, like forward guidance via the dot plot, with the necessary flexibility, the discretion needed to respond to inherently unpredictable events. It's hard to promise a path when the path keeps changing.
Okay, so if the dot plot has this, let's say, patchy crack record of actual forecasting accuracy, what is its real value? Do Fed officials themselves acknowledge these limitations?
Oh, absolutely. They are quite aware of the critiques and the historical misses. Fed Chair Powell himself has been very direct about this, especially in recent years as the misses became more pronounced.
What has he said?
Bankrate quotes him saying quite explicitly that the dot plot isn't a forecast, it's not a commitment. That's a really key distinction from the Fed's official perspective now. They try to frame it not as a hard prediction or a promise, but more as a snapshot of individual participants' views based on the information available at that specific moment in time.
Which makes sense logically because the economy is constantly changing, right? And the Fed always emphasizes that their decisions are data dependent.
Precisely. Their policy decisions are ultimately driven by the incoming economic data, inflation reports, jobs numbers, growth figures, not by locking themselves into a forecast made months earlier. As Ryan Sweet, chief economist at Oxford Economics, is quoted saying in Bankrate, the dot plot gets dated pretty quickly. The economic landscape shifts, new data comes in, and the assumptions underlying those dots from 3 months ago might no longer hold.
So the Fed needs flexibility.
They need flexibility, and that's the tension. The dot plot was introduced partly to reduce uncertainty by signaling a path, but the need for data dependence means that path is always subject to change, which can create uncertainty if the signals keep shifting.
Julia Coronado, a former Fed staffer quoted by Bankrate, adds another layer to this critique, doesn't she? About potential confusion.
Yes, she raises an interesting point. While she acknowledges that the dot plot does increase transparency, it lets the public see the full range of views, including those of the non-voting Reserve Bank presidents who still participate in discussions.
Which could be seen as a good thing.
Right, more information. But she argues it can also be confusing, and it can be misleading. Because it presents this whole scatter of dots, including views that might be outliers or far from the committee's consensus, it can potentially add noise for market interpretation, rather than clarifying the likely policy direction. People might focus too much on a few hawkish or dovish dots that don't represent the core view.
So it's a tool born from this genuine desire for transparency and maybe more effective forward guidance back in 2012.
Right.
But its actual execution is complicated by the fundamental unpredictability of the economy, the natural diversity of opinion within a large committee, and this has led to a pretty mixed historical track record on accuracy.
That sums it up well.
Although Mergence did offer that subtle defense, suggesting that maybe while it misses the speed and timing, it might be directionally right more often than not.
Yeah.
Capturing the general trend, even if the specifics are off.
Yes, that nuance is important to mention. Their analysis suggested that, barring major unforeseen shocks like the pandemic, the dot plot might have been reasonably okay at signaling the general direction whether rates were fundamentally expected to go up or down over the coming years, even if the projected path, how fast exactly when, turned out wrong. So maybe useful for the big picture trend, less so for the precise turns.
Okay, this has been a fascinating journey through the weeds of the dot plot. We've explored what it is, why the Fed created it, what the most recent one from March 2025 seemed to show, and importantly, how reliable or unreliable it's proven to be historically. Now, let's bring this all home. Let's make this really concrete. How does any of this actually matter for you, our listener, in your everyday financial life? Why should you care about these dots?
This is the crucial connection, isn't it? Because while all this talk about the FOMC, the federal funds rate, SEPI projections, it might seem pretty abstract, pretty distant.
Yeah, very inside baseball sometimes.
It can feel that way. But that federal funds rate targeted by the Fed, the one the dot plot is forecasting, it really forms the bedrock, the foundation for interest rates throughout the entire U.S. financial system. And those rates definitely affect you.
We're talking about the rates you pay when you borrow money, right? And also the rates you earn when you save money.
Precisely. Think about it, the interest rate on your mortgage, whether you're buying a new home or looking to refinance an existing one. The rate on your auto loan when you buy a car. The often very high interest rate on your credit card balances.
Ouch, yeah.
And on the other side of the coin, the yields you receive on your savings accounts at the bank, on money market funds, on certificates of deposit, CDs. All of these are influenced, directly or indirectly, by the level of the federal funds rate.
So when the Fed changes its target rate, or even just signals it might change it, that ripples through to the rates we encounter daily.
It does. And here's the key link back to the dot plot. Those signals from the dot plot, even with all the caveats we've discussed, all the flaws, the historical misses, they can still influence market expectations.
And market expectations can move rates before the Fed actually acts.
Exactly. Markets are inherently forward-looking. They try to anticipate policy moves. Remember that December 2021 example when that dot plot clearly shifted to signal upcoming rate hikes?
Mortgage rates started rising quickly after that.
Yes. Bankrate noted that mortgage rates began to rise significantly in the weeks and months following that December 2021 dot plot release, well before the Fed delivered its first actual rate increase in March 2022. The market saw the signal, anticipated the hikes, and started pricing them into longer-term rates immediately.
So understanding the dot plot, understanding what it's showing, what the median is, what the spread looks like, A and D, crucially, understanding its historical tendency to sometimes miss the mark quite badly. That can provide you with some valuable context, some imperfect insight, maybe.
I think imperfect insight is a good way to put it. It can help inform your thinking around your own personal financial decisions. It's not a crystal ball, we've established that, but it's a piece of the puzzle.
How might someone use that insight?
Well, for example, if you see the dot plot consistently signaling potential rate cuts coming down the road, maybe over the next year or two, that might factor into your decision-making.
Like maybe waiting to take out a big loan if you think rates might be lower later?
Potentially, yes. Or, conversely, maybe it encourages you to lock in a higher yield on a certificate of deposit, CD now, before those potential cuts happen and savings yields start to fall.
And if the dots are signaling, hikes are more likely.
Then the thinking might be the opposite. Perhaps you'd want to consider locking in a fixed rate on a mortgage or a loan sooner rather than later, before borrowing costs potentially rise further. It provides some information about the potential direction, even if the timing is uncertain.
But given its history, the big takeaway here seems to be, do not rely solely on the dot plot as your guide. It's not a guaranteed roadmap.
Absolutely not. That would be a mistake. It's just one piece of information. It's maybe best viewed as a snapshot of those diverse opinions and the acknowledged uncertainties within the Fed at a specific moment in time.
So for making real financial plans, you need to look broader.
Definitely. For genuinely informed financial planning, you need to consider the whole picture. Pay attention to what Fed officials are actually saying in their speeches and interviews, not just the dots. Follow the incoming economic data yourself. What are the latest inflation reports showing? How strong is the job market? Is economic growth accelerating or slowing?
Be your own analyst to some extent.
To some extent, yes. And understand that economic conditions can and do change quickly and unexpectedly. The dot plot can give you insight into the range of possibilities the Fed is considering, and importantly, their own collective uncertainty about the future. Sometimes, knowing how uncertain they are is just as valuable as knowing their median forecast.
This has been a really thorough exploration, I think. We've really dug into the Fed's dot plot. It's clearly a much more complex and maybe less perfect tool than perhaps its proponents might have originally hoped for back in 2012.
It really highlights that inherent challenge the Fed constantly faces, doesn't it? Trying to balance the genuine need for transparency to help guide markets and anchor expectations against the cold, hard reality that economic forecasting is incredibly difficult, and forecasts are often wrong.
So just to wrap up this deep dive for everyone listening, we've seen that the dot plot is essentially this chart published quarterly within the Fed's Summary of Economic Projections. Each dot on the chart represents an anonymous forecast from one FOMC participant, a governor, or a Reserve Bank president, about where they think the federal funds rate should be at the end of future years and in the longer run.
It was introduced back in 2012, largely as a tool for what they called aggressive forward guidance and to increase transparency. The main goals were to help markets anticipate future rate moves, reduce volatility, and theoretically make monetary policy more effective by shaping those crucial market expectations.
We looked closely at the most recent example from our sources, the dot plot for March 2025. The median projection there signaled 2 potential rate cuts for 2025. However, a really key finding was the significant spread of the individual dots around that median, ranging all the way from 0 cuts to 3 cuts for the year.
Right. And that wide dispersion clearly reflected the increased internal uncertainty and disagreement among policymakers at that time, particularly given their concerns about persistent inflation risks, the potential impact of trade policy, and those recent hotter-than-expected inflation readings.
And then we hit the reality check. Critically, the dot plot's historical track record reveals some pretty significant misses when it comes to accurately predicting the speed and the precise timing of actual rate changes. We saw clear examples from the huge underestimation in 2021-2022, but also other periods where forecasts seemed too early or too slow.
Yeah, and this has led critics to argue that these repeated forecasting errors can potentially damage the Fed's credibility and maybe even undermine the intended benefits of the tool itself, even if, as Emergence suggested, it might have sometimes been broadly directionally correct over the longer term.
So ultimately, while the dot plot is certainly intended to provide insight and transparency into the Fed's thinking, its limitations are pretty clear now.
Very clear. It's best understood as a snapshot of individual forecasts that are inherently uncertain and absolutely subject to change as the economy evolves. It reflects the Fed's necessary commitment to being data-dependent and flexible, rather than being rigidly bound by a predetermined path sketched out months before.
Which brings us, I think, to the final, maybe most important question for you, the listener, to consider as you navigate your own financial world. Given everything we've discussed, the acknowledged unpredictability of the economy, the reality of differing expert opinions even within the Fed, and the dot plot's own decidedly mixed historical track record on accuracy, how much weight should you actually place on these specific dot projections when you're making significant long-term financial decisions?
Yeah, decisions like choosing a mortgage type, planning your investment strategy for retirement, figuring out how to manage your savings.
Exactly. Is the dot plot a true forecast that you can reliably build your multi-year plans around? Or perhaps is its greatest value simply as a piece of context, a tool that illustrates the diverse range of opinions, and maybe more importantly, the acknowledged level of uncertainty within the central bank itself at a particular moment in time? What does it really tell you?
It's certainly more nuanced than just looking at that median dot and assuming it's destiny. That much seems clear. And maybe the next time the Fed releases its summary of economic projections, we'd encourage you, armed with the understanding from this deep dive, to actually go look at the dot plot chart yourself. See what story the pattern of dots, the spread, the changes from last time tells you.
That's a great suggestion. Well, thanks for joining us for this deep dive into the Fed's dot plot. We really hope you feel better equipped now to understand this complex, influential, and sometimes controversial tool, and what it might or perhaps what it might not be signaling about the future of interest rates.